I see the US housing market in a bit of a tug of war. And on one side, you have tight resale supply. So if inventory is very tight, that's going to be a tailwind for prices. On the other side of the tug of war is the headwind. And this headwind is the very unaffordable housing market. Affordability levels are just very unhealthy right now.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. While 2023 was a much better year for the financial markets, the housing market has fared less well. Instead, 2023 was the year that gravity caught up with rising home prices. They've stopped rising nationally for the most part, and certain once red-hot cities are now starting to see clear declines. Is this the Wile E Coyote moment before prices start plummeting under today's high mortgage rates? Or will the housing market prove resilient as we enter 2024? To find out, we'll talk with real estate analyst Lance Lambert, former real estate editor for Fortune and now co-founder and editor of ResiClub. Lance, thanks so much for joining us today.
Yeah, thank you so much for having me, Adam. It means a lot. Really excited to come on here and have a chat about housing.
Thanks. Really excited to have a chat about housing with you, and thank you for joining us. I know that you've been under the weather, and you're kind of coming out of that to talk to my audience. So thank you. For folks watching, I'll give more details about this later. But thanks to everybody who sent me such nice well wishes about my father. Just a sad update: he did pass away this weekend. I know I told folks I might be away from the camera this week. I probably won't be, given that I'm now back in California. And also, it's sort of part of my process for dealing with adversity is just to sort of throw myself into work. So for those that are worrying, this is more therapy for me than not. So anyways, thank you everybody for your kindness and your understanding. All right, Lance, back to the main topic here, housing. Lots of questions for you. It's a topic that comes up a lot on this channel, and I usually don't get that much time to drill into it with my guests unless they're housing experts. And I haven't had one on for a while, and this is your first time on the channel, so I'm really excited to get your thoughts on what's going on here. Just to set the stage, can you give an answer to this intentionally broad question, which is, what is your current assessment of the housing market, the U.S. housing market right now?
Yeah, I see the US housing market in a bit of a tug of war, is how I see it. And on one side, you have tight resale supply, where the active inventory on the market is still 38, 37, 39% below pre-pandemic levels. And so I really look at that as the balance of the equilibrium of the market for the resale side. So if inventory is very tight, that's going to be a tailwind for prices. But on the other side, on the other side of the tug of war is the headwind. And this headwind is the very unaffordable housing market. Affordability levels are just very unhealthy right now. Back in October, when the average 30-year fixed mortgage rate briefly hit 8.03 as measured by Mortgage News Daily, that put us at the worst affordability levels in 4 decades. So affordability this fall was worse than it was in like 83 and 84. And a lot of these years when you had 11, 12% mortgage rates. And the reason being is that when you take into account mortgage rates, house prices, and incomes, it's just very unaffordable right now. So you have gotten some relief with mortgage rates coming down a bit and the 10-year coming down a bit. But at the end of the day, this is still very unaffordable affordability. So unhealthy affordability on one side and tight resale supply kind of has the market in a bit of a stalemate.
Okay, so bit of a stalemate right now. I've sort of used the term like, a high noon showdown. You got buyers and sellers kind of squinting at each other across the main street there at high noon. Let me just ask you this, and we're going to get into the details of all of this, but let's just say current conditions just persist, right? Which one wins out over time? The stalemate can't last forever. So if the status quo continues, which side breaks?
Yeah, I think it's hard. Well, I think the truth is right now, there is a bit of a stalemate with the tug of war. And so the most logical answer is we're grinding. So are we grinding down a little bit? Are we grinding up? And that's where it's really tricky to figure out. And, the difference between the two scenarios of a market that's going to grind down on prices for a period of time, like let's say 3, 4 years, and a market that's going to just grind up a little bit over 3 or 4 years is probably a market that isn't that different. Like the difference between the two scenarios might not be that large. But what is interesting is that when we've seen markets just get some supply, get active listings up just above pre-pandemic levels or pre-pandemic levels, like Travis County, Texas, and pockets of Texas and pockets of Louisiana and some smaller parts of Florida, we've seen prices give in. We've seen prices weaken. And what moved active listings up in those markets is not that there was a ton of resale supply coming on. Actually, Austin, which is the market down the most in the Zillow Home Value Index, they're down 19% for home prices as measured by the Zillow Home Value Index. Austin has actually seen a decline in new listings. The number of homes coming up for sale in Austin, in the market there, is actually down. So how is Austin down for the number of listings, but then inventory grew there and grew enough to get to pre-pandemic levels? Well, what happened is they had a more acute hit to demand in Austin. And in particular, as people, like the COVID migration let up, and the fact that fundamentals in Austin were so distorted because that outside money came in during the pandemic, pushed fundamentals too far beyond local incomes, then mortgage rates spiked and they were just too far beyond. So the demand shock was greater. So the question is, if some of these other markets start to get more acute hits to demand, let's say unemployment were to rise more than it is today, and actives could grow, would that put us in a spot where more of the markets are seeing price declines? It's a great question because on the other side, though, if that did occur, affordability could improve some if rates were to also come down. But I think what the data is telling us right now is we're seeing a lot of regional bifurcation, which I'd love to get into more. And there is definitely a vulnerability to prices falling.
Okay, so bifurcation, literally my next question. So why don't we just go there right away? So can you define it, explain what's going on and why it's important right now?
Yeah. So one of the things that's occurring is that when mortgage rates went up a bunch and affordability deteriorated, we saw across the housing market a shift in demand. So some people weren't necessarily getting priced out altogether. Some of them were moving down the spectrum. So they were going from, let's say they were going to get a $750,000 house and now they're looking at 450 or 500. And so as that moves down, you actually keep a lot of pressure on the bottom of the market. And then also another thing that occurs is that people who own entry-level homes, let's say somebody who bought in 2018, 2019, they bought a two-bedroom house, but now they have two kids, right? And they would love to have a three-bedroom, but in this current affordability environment, they're not eligible for a mortgage for that bigger house. So they're having bunk beds, they're staying put. And so by them staying put and not going out and buying a bigger home, what that is a net decrease in supply at the bottom of the market and a net decrease in demand at the middle to top of the market where they would go. And so what that's doing is it's making the bottom of the market hotter and it's keeping the top of the market a little cooler. And so markets where they lean more towards a high, more expensive homes like San Francisco and Seattle, those places have been hit harder because the tops of the markets and these higher price points have just been hit harder. And then the markets where there's more affordability, let's say the Scrantons of the world and places where you could still even buy properties, the cash flow, they've been warmer. There's been more competition. And so what we've seen this year is we've seen an increase in prices on the national level by very little But if you unpack it, you're still seeing a lot of declines in these higher priced markets. But the bottom third of the market in the Northeast and Midwest has actually been fairly hot. Like we're talking up 6 to 8%. And that sector of the housing market is what drove the national increase this year. So without the bottom third of the Northeast and Midwest, we wouldn't have seen prices probably up this year, year to date for 2023. It was just that piece of the market was so hot. And another part that that corner of the country saw is the donut effect, where around a lot of these major markets, they were no longer doing, fully remote, right? A lot of the employers, especially in the Northeast, are no longer fully remote. They've called some people back in, but they're 1 to 2 days in the office. And so instead of people leaving New York and San Francisco for, let's say, Boise and Austin, we're still seeing the work from home arbitrage, but it's more of like, okay, let's go out further into Connecticut. Let's go out further into New Jersey. There's a rail now going from Scranton into New York City. And so you've seen some more there. Actually, Scranton has the most house price appreciation. Well, it and Rochester among the markets I track. And so you're seeing some of that work from home arbitrage, but it's changed where it's pushing up. And it's no longer the Boise's and Austins. And now it's more of like exurbs, really far exurbs, and kind of third tier, fourth tier cities and markets.
All right. Great. And I have a question later on down here about asking about the impact of work from home, and maybe we'll still revisit that. But it sounds like you're seeing it is still influencing the real estate market, and it's kind of still evolving, right? So maybe you can't go live, in the beautiful mountain town that's states away from where you were working. So you're going to stay near your employer, but you can get further away from your employer into a more affordable market, as long as you can get into that office for the 1 or 2 days a week they're asking you to get
Yeah,
there.
and so big picture here is the housing market is so unhealthy with affordability that buyers, when they're transacting, are trying to do anything they can to get some relative affordability. And so that's why the places and the parts of the country that saw appreciation, it was that impact where it was, kind of moving down and a shifting of expectations to different places and different types of homes.
So
That's my view.
let me ask you this. This has been sort of my assessment as a non-expert of the housing market for many years. I mean, pre the COVID craziness with prices too, we could have had this discussion back in 2018 or 19, which is that the home price to income ratio, has just been creeping up and creeping up, and that's what's getting just crazy right now in terms of the unaffordability index. And what I hear you saying is this bifurcation is basically people shifting both of the geography and the type of home that they're looking to buy, because it's kind of the only one that they can barely sort of make pencil out, right? But I still feel like we've had years of people really stretching to get into the home, right? And a lot of people were willing to do that because homes were appreciating so well. They just had this confidence that the home was just going to keep going up, right? So I get in and I won't be priced out forever. And yes, even if I have to pay this ridiculous price, I can get a mortgage for it. I can make it pencil out that I can still like put food on the table and pay this mortgage, right? It sounds like what I'm taking from you is people are still at that stage. It's just that their options are more limited now, right? And so people are still really stretching to get these maybe less ideal solutions. So are we indeed, is that sort of a correct assumption? Like, are we
I
still
think
indeed
so.
forcing the consumer to stretch?
So you're right. So the consumer mentally felt like they were stretching themselves back then to buy, right? They were kind of like, going and spending more than they thought they should. And, affordability was already an issue in their mind, right? But with the run up in prices we saw during COVID, and now the mortgage rate shock with mortgage rates going up so high and affordability moving now to this new level, the barrier there in terms of them stretching themselves is no longer just in their mind stretching themselves, they are literally up against like the debt to income rules and like lenders limits on them. So they've pushed all the way up to the limits. And now that is like the barrier that is like, okay, you cannot, you like, we can only go so unaffordable within, the boundaries of the law, and people still be transacting. And I think during this past year, we've kind of gotten closer up to that. So it's like a different type of level of unaffordability.
It sounds like even worse. So where I'm going with this, and I'll just ask the question here, which is, to me, this is not a healthy housing market. I mean, I don't think it's been for a while, but I just think nationally, you don't want to have a housing market that is forcing your average home buyer to stretch uncontrollably to get into an imperfect solution. It's almost like they're on the plank and they've got a sword at their back, right? It's like it's kind of their only option at this point if they want to buy. To me, that just doesn't sound like a healthy market that if you were running a country, you would want to have your housing market be like. Am I painting too dire a picture, or is that accurate?
It's a very unhealthy housing market, and that's why, people are so interested in it right now because it feels, there's some people who just feel like I can't do it. There's not a path to it for them personally. And I think if you look at affordability in, let's say, people who are existing homeowners who've owned for the past decade and they have fixed debt, it's 2-3% mortgage rates for them, they feel housing affordability is fairly decent for them, although some of them are getting insurance shocks and property tax shocks now depending on where they live. And then in the rental market, of course there's some cities where it never feels affordable to rent, but relative rents relative to incomes aren't too bad relative to where the purchase market is. So the biggest part of the stress in the market is people trying to go buy a home at today's mortgage rates and today's prices relative to their incomes. And so, it's a bit of a question of, how many people start to realize that, rent to buy ratios and the math for their own life, they can find some of that relative affordability now in the rental market. And, you know, so it'll be interesting to see how the cycle plays out. We're just in a place where affordability is very unhealthy for housing. The problem is finding the mechanism down on price, right? So you look back 15 years ago, active listings built very high, right? Then there was also a tightening of credit standards where who was eligible for a house in 2008 shifted. They changed the laws. And so there was a credit tightening there that occurred. And then you have the foreclosures and the fact that unemployment moved up very quickly, very fast. And so unemployment moving up very quickly, very fast, that cycle completely negated all of the benefits of mortgage rates coming down. Like mortgage rates coming down at the time did nothing to help save that 2008 bubble. But what you had is you had the mechanism and the force down on the market. And as of today, we don't really have that right now. And that's why we're in so much of a stalemate with some markets grinding up still on price and some markets grinding down on price.
Okay, so we have this, I guess keep using this word stalemate, right? But we have this sort of market in limbo right now. And we have a lot of buyers who are at their max stretch point, right? We'll say. So, let's try to think of what could make prices go up, or prices go. Well, let's start with the upside first. Like, what would it take for prices to go up here? And I guess it would be obviously mortgages would get cheaper, right? And that would help. But probably I'm going to guess a lot cheaper, right? Because mortgage rates are pretty much they're more than double than where they were 2.5 years ago, right? So even if mortgage rates have come down from 8 to about 7 now, I think if they come down to 6.5, 6, yeah, it's getting cheaper, but it's still almost twice what it was,
Yeah.
a few years ago, right? So, but that would help, obviously. I guess some like incredibly dramatic economic growth that resulted in faster growing wages for everybody would help. I'm not sure that white knight's going to ride to the rescue anytime soon at real scale. like what are the other arguments to be made here for, well, we're in a stalemate here, but things are going to start resuming again?
Well, so I think one of the parts. So I recently had an interview with Sean Dobson, CEO of Amherst, and they own 44,000 single family homes. And his view of the market is it's just very hard. There's a lot of uncertainty to forecast right now. But what's occurring is that the reason that, we're up a little bit nationally for prices this year is that the technicals of the market, the fact that resale supply is so tight, it's that is what drove up prices in his mind. Now, affordability is very unhealthy, but just the fact of where the supply demand equilibrium is with existing inventory being so low is driven up prices some. And I think that the markets where that's even more extreme, like let's say the Hartford, Connecticut's of the world, the Rochesters, I think those markets as we move into the spring next year are probably going to see prices rise until they get out of that spot. Now, can they get out of that spot? Yeah. You go look at Austin, where Hartford and Rochester are for supply for active listings, is where Austin was entering 2022. Austin had, they were down 70% from pre-pandemic levels for active listings. I mean, the whole greater Austin market was like 2,000, 3,000 homes for sale. And now they're up to like 10, 11,000. But they had what they had occur as a demand shock, and demand finally broke, and it created just enough relief in the market as days on market went up that inventory was able to build, and then the prices were able to fall. But right now, there's a good chunk of the markets that are probably heading into next year going to probably see price appreciation through the seasonally strong period until something can occur that breaks the technicals of the market in a different way.
Okay, so it seems like so much of what is propping the national housing fleet up is this super tight, these tight inventory, right?
Yeah.
And there have been lots of narratives of, oh, U.S. housing's super underbuilt and we just have chronically low inventory. I've heard arguments made on both sides of that. I think one of the things that's keeping inventory so low, you mentioned earlier, is the fact that what is it? It's only a tiny fraction of U.S. homeowners right now have negative equity in their house because houses appreciated so much, and many of them are sitting on those low interest rates, right? But they're kind of trapped in their homes right now, right? Like probably some material percentage of them would like to move, but when they look at what they're going to get for their money if they move, in many cases it's a worse scenario, right? They're gonna get rid of this very low mortgage and they're gonna buy a house that maybe not even be as nice of a house, but have to pay a lot more for it, right? So I guess my question is what is the true status of inventory here? Yes, the transactions are currently tight right now, but is there a lot of inventory that could hit this market, say if prices start going down? And Austin may be actually showing us this, right? It looked like a super tight market, and then all of a sudden there's a lot more inventory there. And yes, that was one of the markets where developers were building more aggressively in. But you have that, but then there are vacant homes out there. There are second homes. We'll talk maybe about short-term rentals a little bit, but like as some of those, the inventory of that market maybe starts being negative cash flow, you might start seeing those guys start dumping inventory on market. At some point, we'll talk about the institutional buyers as well. Is inventory really chronically tight and it's just something in America is going to have to take years to get into balance? Or is there inventory that could come onto the market quite quickly given other dynamics?
Well, so I think the structural supply discussion, I think, is a bit different from the discussion of can a market have a correction? Like, so, I think there's a good possibility that, a lot of these analyses are right and that the US has, not enough housing units. But that didn't stop Austin from having a correction. Like it could be true that we could have a shortage of homes and still have corrections of housing markets where the fundamentals just went too far during the pandemic housing boom. And if there's an opening because affordability so deteriorated that we have a correction, right? Regardless of if there's enough housing units. because it's possible that the housing units that we have just gotten priced too high, right? And so Austin had a correction, and Austin probably, you could make an argument, is still, structurally short on homes, but they just got priced way too far above local fundamentals. And so Austin was able to have this correction because days on market shot up really fast, and pretty much just what was pushing prices up was the inventory was low. And so inventory staying low just kept pushing it up, and it was overheating. But as soon as it got brake checked and days on market was able to increase, then they were able to just build with some of the actives. And so it's possible, because what you've seen now is a few more markets that didn't go into correction right away last year are now seeing correction this year, like New Orleans. New Orleans is now down 13% from peak in the Zillow Home Value Index. And what occurred there was not a ton of listings coming on the market, but just demand pulled back. I don't know if it's because of home insurance increases in Louisiana. I don't know if it's, things about like the push against short-term rentals, but whatever it is, they've seen the active listings grow closer to pre-pandemic levels, and then prices softened. The problem is that housing economics is not an exact science, and a lot of people pretend it is, and we know exactly where house prices are going, but the truth is it's not. It's an inexact science, but every cycle gives you clues. And I also think it's important to pay attention to what drove the prices up, because that can give clues to the back end if there could be some relief. So last cycle, a lot of what drove up the increase is, the mortgage products, right? There was the looser lending standards, and some of those mortgage products helped to generate more existing home sale volume. People got into some of these products with like the teaser rates and all of that. And, as interest rates moved up and they had to refi, they were in trouble.
Yep. And you're talking early 2000s right there, right?
Yeah. What helped? Yeah. So the thing I'm getting to there is, what helped to bring the market up was the same thing that helped to bring the market down. This cycle was very different in that when the pandemic housing boom, when the lockdowns occurred, what happened is that there was an acceleration in housing demand. Housing demand took off. And what occurred is there was an increase in demand for space. And it wasn't just the people who were going work from home. So, I was at Fortune at the time, and when I left Fortune's office and went down the elevator and they'd sent us home for a week, I knew that day, I was like, you know what? I'm probably going to move home. My wife and I are both from Cincinnati, and we're going to build a house. That was the first thing I thought of was, I'm done living in New York. I've been there 5 years, was never going to own a home in New York. And if I was going to have to move out really far. And I was like, you know what? I'm moving back to family. Everybody, this is going to be remote. I'm going to show I can do my job and get out of here. But so it wasn't just that effect. It was also the people who stayed in a lot of these cities and who were like sick of living with their roommates. They're like, you know what? I'm not going into the office. I got to work from home. And this roommate I have, I don't like him as much as I thought. When I was around him 1 to 2 hours a day, it was fine. But this 10 hours, I'm done with them. And you saw people who had like 2-bedroom homes or 2-bedroom apartments that now both of them were working from home. They wanted more space. And so that helped to drive up home prices, even in markets like San Francisco.
Right. And sorry to interrupt, but on top of that is all the stimulus that went out there.
Yeah,
too.
I'm getting to that too.
Okay.
Yes. So you had an increase in demand for space. You had work from home arbitrage, where you could go into a more affordable market and buy more real estate than you had in your current market. And then you also had the stimulus money and record low rates put on top of it. And so the Fed estimates that housing demand increased, that housing supply would have needed to increase 300% during the first 2 years of the pandemic to match the elevation in housing demand. And so the elevated housing demand never was fulfilled. But what it did is it overpiled on the supply and overheated the prices. So the amount of housing demand that was actually out there to buy, like if you actually included everybody out there trying to buy rentals and everything that was on the market or everything that was, chasing homes in 2021 into spring 2022, they just couldn't get in, and so prices overheated. But the reason I'm going there is if you actually had a sharp pullback in the work from home effect, and that were to contract, right now we've seen, some return to the office and some of that, but you haven't actually seen work from home considerably correct. It's still up sixfold from where it was in spring 2020. And if that were to occur, then I think that would be that could create a cascading correction that we're not really talking about and thinking about, that would hit at all the places that benefited from that boom.
Okay. Definitely a big factor, and that's one of the ones I was going to get to. So we talked earlier about what could tell the story of higher prices. I think the list is longer for what could be driving prices lower, and certainly a huge one is just employment, right? I mean, if we were to fall into a recession that had, substantial layoffs like we've seen in some of the past couple of recessions, hundreds of thousands of people getting laid off per month, I assume that would really change the picture, whether or not they're being called back to the office or they're just being told, no, don't come back to the office because we're laying you off.
Yeah, I think it's a great question. You go back and you look at the past few cycles, and in the early 2000s, that recession, which unemployment moved up, but mortgage rates moved down. And that one you had seen home prices actually, that was actually around the time the home price boom started. And we were up actually double digits in the year of the recession that year. Then you go to the next recession, the great financial crisis, of course, housing prices tanked. And that was the worst ever national correction for home prices, in very unique cycle of the post-World War II era. And then you have COVID, which is a very brief recession, but you had also seen record stimulus, the onset of the work from home effect, and then 2% mortgage rates, and then home prices boomed. I think whatever this cycle is, if we had a recession, I don't think it would be either of those three cycles, which two of those were housing booms and one of those was a historic housing crash. I think it would be its own unique cycle, and it could actually be a cycle where there's a good amount of bifurcation in the market, especially if it had what I was discussing just before, which is a correction to work from home that would benefit some markets, and then that would actually, and then of course, negatively impact others.
Sure. And real estate, super local, location, both in the property and in the city that you live in. So that'll always continue to hold true here. But let me just ask you a couple of questions to get a sense for how material these factors could be. One, I mentioned earlier that right now you've got a lot of people who are homeowners who are sitting on equity and who have a low mortgage rate, right? So I imagine most of them are just trying to play the wait game here, right? Let's wait until mortgage rates come back down, and that'll hopefully push the price of my house up even more, but it'll also make it easier for me to sell and go buy somewhere else, right? And we do have, the vast majority, I said the vast majority, but a material amount of those homeowners are boomers, right? And actually some of them, not a small percentage, own multiple homes, right? They got their main home, they got a second home, whatever. But for a lot of people, a lot of older people, their retirement, like their home equity is a big part of their retirement, right? So if we got into a situation where home prices started coming down from here, right? Maybe because of rising unemployment or whatever factor, right? But if they start seeing their home equity going down and thinking like, that's what I've got to rely on from here, could that be a prompt to like trigger a wave of selling here as people start saying, well, look, I don't want to be the idiot that holds on too long. I want to get out sooner. Maybe I'll price to sell, just a little bit below the market, and I'll get 95% of what remains of my home equity, and I'll go rent or do something else, but I'll have that at least. if I'm worried that the housing market could go down substantially further? Like, could we start this domino effect of sellers trying to scramble out?
You know, I'm not 100% sure that it's a tough question, and it's, you know, the boomer thing in general is just something very interesting to kind of figure out the next, not just 3 years or 5 years, but really 10, 15 years, like how all of that plays out.
Please
That's a
take it there
really
because
big
I've got a
question.
question about that too. So
Yes.
let's go
Well,
there.
that's a really hard question to answer, because right now I'm laser focused on like this cycle and how do we just get to a place where affordability is a little closer to historic norms and kind of what gets us there. But I think on the boomer side, the fact is there's just not a ton of stress on that end of the market. And they are actually probably a part of what's been a tailwind for the market that we've been in now, especially with so many of them having, uh, you know, not having a mortgage, like they're mortgage free, high equity.
Right.
Okay, so
But they're not stressed yet because prices haven't been coming down yet. Maybe they'll start sweating if that reverses. But anyways, keep going.
yeah, so it'll be, you know, one of the things I'm interested to know is you've seen a lot of these retirement places because the boomers are such a big generation. They were very wealthy. They went out and bought a lot of real estate as they retired. And, you know, and we've seen a lot of places, especially in this, you know, around Florida and parts of the South, have really moved up a lot in prices. So one thing I'm really interested to know is, where does the next generation retire? Are they going to go to the places that the boomers just made very unaffordable? Are they going to be picking like new pockets? And that's an interesting question that I don't see getting asked a lot, which is, are Gen Xers going to retire to the same places the boomers did? Because there is the negative impact that, you know, the boomers just made those places all very unaffordable.
Well, okay, so let's even precede that, right? Which is first, you know, a lot of Gen X, like, who are the boomers going to sell their homes to, right? Like they've pushed this whole McMansion strategy, right? And we've sort of seen this, you know, disinterest in that from these younger generations. One, because they just, in most cases, can't afford them, right? And they're looking at more like more modest sized homes or tiny homes or whatever. Like they just don't have a huge aspiration to be purchasing this 6,000 plus square foot place that has lots of maintenance costs and stuff associated with it. So that's an interesting question, I think, of just like, they don't have the ability to afford it, nor necessarily the desire to own it. So that's one big question, which is, are the boomers going to be able to sell their current fleet of inventory to enough willing buyers? Maybe not, right? Um, but so here's the big question I have around this, which is, well, actually, sorry, two. One is, you talked about how boomers have bought a fair amount of real estate. Like, you know, the affluent boomers oftentimes own more than one property, right? And one of the things that had happened was, you know, boomers are getting older and they tend to downsize as they get older. What I've heard, and I'd love for you to corroborate if this is true, is that if they do, they are often not actually selling their larger house. They were renting it out because it was a source of cash flow and it was like a stock in their portfolio. Oh, it goes up every year. So why would I want to get rid of that asset? It's appreciating and paying me a cash flow, right? So if a boomer gets into any sort of you know, an economic pinch because the economy is slowing or just their own personal situation, you would think the first thing to go would be that extra house, right? Like, oh, well, I'm not living in it. You know, it's not an essential asset to me. I'll just dump it, right? Is there a potential for that phenomenon to happen?
Well, so one thing that I think is probably going to be true is that if we don't see a period where affordability meaningfully corrects, right? Whether that's through a bigger decline in mortgage rates, or it's, you know, income surprise to the upside, or prices come down more than expected, or all three are really working together to improve affordability. If we don't see that, then the housing market is probably going to be in a place where, on a regional basis, we're going to be vulnerable to different types of corrections that we otherwise wouldn't have been. And so could one of those be through the mechanism that you're kind of discussing here? Potentially. And, you know, we were in this place before in the 80s we saw in the 70s and into the 80s, we had seen home prices boom a lot. And then we had seen mortgage rates go up a lot and they came down some, but affordability was very strained through the 80s. Well, what occurred in the mid 80s is that there was an oil bust in Texas
Mhm.
and the S&L crisis. And so what we saw is a home price correction through a lot of the markets in, parts of the South, and a lot of Texas, of course, was the epicenter. Austin, I went back and checked the numbers. It was down like 30% almost peak to trough, which is bigger than the national decline for the crash. And I think a lot of the vulnerability there was that affordability was just very strained coming out of the 70s and the 80s. And could we be in a similar situation where we don't get a meaningful correction here in the next few years for housing, but it puts us in a place where some economic events occur and create regional corrections that otherwise wouldn't have occurred? I think that might be a possibility.
Okay, I've got a couple other like what ifs that I want to get to, but while we're on this topic of sort of boomers and affordability, let me ask you this sort of much larger question. And I had a really interesting discussion with Ivy Zellman on this recently, which is, 10,000 baby boomers hit retirement age every day, right? At some point in the next 10 to 15 years, that's going to be 10,000 baby boomers go to the nursing home or pass away, right? So you're going to have presumably kind of a downward selling pressure for a prolonged period of time, at least in the housing stock that is currently boomer owned, right? Where there's just you're going to have these forced transactions, right? Now put yourself in the mind of an aspiring younger buyer at today's prices, right? And you're thinking, all right, I'm going to buy a 30-year mortgage on this house. I'm kind of making a 30-year commitment here. I mean, obviously you don't have to own the whole time, but like, I'm going to buy this asset that I'm going to be paying off for the next 30 years. But halfway on the way to paying it off, there's going to be this headwind, increasing headwind of downward pressure in housing because of these boomer sales. Like, I know most aspiring home buyers probably don't think that far ahead about these type of issues, but it does beg the question, like, why would I be stretching to buy this asset if halfway through my tenure of holding it, it could very well go down for this reason?
Yeah, it's a great question. I think it's, you could potentially go through a prolonged period like that. And, even if it's downward pressure, it could be a situation where it doesn't necessarily cause housing prices nationally to move down a lot, but instead creates a window where incomes rise faster than house prices for a prolonged period, which is what we saw in the 90s. I think, a lot of people would probably love to see a replay of the 90s because while it didn't see prices come down a lot, it's all very tame house price growth through the 90s relative to how strong the economy was and how much incomes went up, and affordability improved through a lot of the 90s. And so it's a hard one for me to answer the demographic play out of how the boomer uh, I don't want to sound cold saying it like roll off, but how the demographic shifts of the country occur and how that plays out long term, it's really hard to tell. And especially when you have unexpected events like COVID, where it causes an overheating of house prices because of the policies and work from home policies and the stimulus policies and QE policies and all of that, and just that huge overheating that happened very quickly and unexpectedly. Uh, Things like that also make it really hard to project out long term for housing.
Okay, so tricky, but I'm just curious, is it something that concerns you?
I'm a homeowner, and it's not necessarily something that's keeping me up at night.
Okay.
I think the bigger thing is just the short term, which is this economy actually going to pull off the soft landing that is now? It seems like the biggest talking heads now. It's like presumed here, and that they talk about it as if it's already occurred. And so does that actually occur, or does labor, break unexpectedly? And how do we kind of move through the short term here? That's what I'm most interested in, because the labor side of it, that's outside of my wheelhouse. But that matters a lot for my wheelhouse, if that makes sense.
Absolutely.
And so that's where a lot of my headspace is, just kind of like watching how that side plays out. And I don't have a big opinion one way or the other.
Okay. Well, we're going to get to your outlook for housing in just a moment here, and I do want to give a little preview. I just, like an hour before sitting down with you here, Lance, I interviewed Michael Howell, who I'll just say, if his predictions come true, he'll be your best buddy. He is actually remarkably optimistic about where both the markets and the economy are headed over the next couple of years, and it all has to do with liquidity. And that interview is going to release a couple days after this one, Lance. So folks, if you're watching this video with Lance the day that it comes out, keep your eyes peeled for the next couple days for that Michael Howell one to come out. But yeah, if you're hoping for housing to go back up, cross your fingers that Michael's predictions are correct. But before we get to your housing outlook, Lance, just your thoughts on two other factors that are going on in housing, which I think are different in this cycle versus previous ones. So first, we've had the explosion of short-term rentals, and during COVID, right? I mean, it seemed like everybody who could get two nickels was leveraging them to try to buy property to then rent an Airbnb. That boom in Airbnb purchases, I believe, has substantially subsided, though correct me if that's a wrong statement. And I think, to me, that sort of smells like one of those late cycle things in housing and in a housing bubble where, everybody finds the easy way to get rich, and you get all these newbie investors piling in who don't really understand the economics or have never done this before, and they pay way too much, and they probably get, poor financing terms. And then the worm turns, and their dreams of a property that was going to be, kicking off riches for them, all of a sudden turns into a cash hemorrhaging asset. And of course, we've seen localities start to turn against Airbnbs because, they're turning neighborhoods into party zones and stuff like that. So how big of a factor is the short-term rental phenomenon to what you expect to happen from here in housing?
Yeah, so I'm kind of in the camp where I think for the national housing market, I don't think it's a huge driver one way or the other for the national, like, total housing market. But on a regional level, it is significant. And there's a lot of housing markets already where they've seen corrections in the short-term rental space, and they've seen a lot of short-term rentals not sell anywhere near their peak values. And so there are short-term rental corrections occurring, and it's occurring, and those sub-markets are falling despite national prices kind of holding steady or even moving up a little bit. And what we saw is that during the pandemic, of course, people couldn't go on cruises, they couldn't go on international travel, and they were working from home and had more demand for space. Short-term rentals took off, right? And so the demand for short-term rentals moved off very quickly. Of course, it was a stimulated economy. And so the rates for short-term rentals rose, right? At the same time, a lot of people wanted to buy short-term rentals because home prices were moving up quickly. We were in a housing boom. Mortgage rates were very low, and they saw all these people they knew making tons of money hand over fist with Airbnbs. So they wanted to get in. Well, that increased the supply of Airbnbs heading into last year and also into this year as they kind of came onto the market. And as that occurred, you saw a pullback in the demand for short-term rentals. International travel came back, cruises came back. Some people who were, traveling around the country at Airbnbs now had to go back into the office. So we saw some of that demand come down. We saw the supply of short-term rentals move up. And so what that creates is a correction. And we've been through this place where some of these Airbnb owners have had to decide, am I going to keep my rates and just not make anywhere near the monthly revenue I did before, or move down my daily rates? And so a lot of them have moved down their daily rates. Some who aren't cash flowing how they thought have had to sell. Some have just moved them into long-term rentals, but we have seen some correction in the short-term rental space. I think the potential for it creating a huge cascading effect through the national market probably gets overplayed. But I think some of the people who are very bullish on housing have probably overlooked this correction that's already been occurring just because they don't really know how to like measure down to the local level, which when you cut the data at a local level, you can see it is there in some of these submarkets. But it all is based on the local short-term rental economics and how fast demand has pulled back and how much supply has actually come on in the short-term rental space.
Okay. And, part of the reason why I'm sort of digging into some of these things is housing is priced at the margin, right? So, one house in the neighborhood can reset the comps for the entire neighborhood, right? So if you have these new sources of inventory that we just don't have that much of, or haven't had that much of, recently, start to come on the market, it can impact everybody. Now, of course, short-term rentals, not every market experienced the same short-term rental boom. So it's probably going to be in those areas where, they were overbought. And to your point, where demand is suddenly cooled off the most is where you'll probably see this impact the most.
Yeah, I think that's right. And I think that whole idea of prices set on the margin is very important. And I think that's depending on where that person has fallen, that's why some of these markets are down and some of them are up. Do you have a second for me to share a map?
Absolutely. Please do.
So we hear a lot about US home prices as measured by like the Zillow Home Value Index being up 2-3% for the year. That's true. Here's what it looks like when you look at the county map for the whole country. This is year over year. It is it's through October. I do have data through November, but it looks very similar either way. But what you will see is that there's a good amount of weakness in Mississippi, Louisiana. Let's see here.
Yeah,
Yeah,
so you see double digits down. Yeah.
yeah. You have some weakness through there. And then Texas, of course, there's Travis County down 15%. That's where Austin is. And then, of course, a lot of these places that were, Zoom towns during the pandemic, you've now seen prices come down some. You've seen softening up in the Seattle area. Northern California has seen a lot more than Southern California. Southern California actually recovered a good amount this year relative to the correction last year. And then Florida is very interesting where Miami-Dade and Southern Florida have been fairly strong, but the Western coast, especially in like Cape Coral and Sarasota, have been much softer. And then as you move up the country, you start to see this like Wisconsin, Illinois, all the way over to Maine, Connecticut, Massachusetts, much stronger. And then everything above North Carolina, really, other than a patch of like, West Virginia, much stronger that has kind of pushed up prices. But this is not what prices usually look like year over year back in like 2017 or 2018 or 2019. You've definitely seen some price give up, even if on the national level, prices are still moving up. But at the same time, you have pockets of Wisconsin and Connecticut where inventory is still down 75-80% from pre-pandemic levels, and prices, just because the technicals are where they are, pushed up more this year.
Got it. But yeah, this chart is an important one for the point of the marginal buyer, which is, you'll hear something like home prices are up nationally, by X%, but this is really telling a tale of two different Americas, right? I mean, roughly half the counties here are down and half of them are up, and it all depends upon what's going on in those regional markets.
Yeah, exactly. Yeah, there's a lot, and that's why I use that word bifurcation a lot. There's a lot of bifurcation happening in housing right now.
Okay. We're running out of time, and I do want to get to your housing outlook. I was going to ask you about the new home market versus the the existing home market. If there's anything you want to say about that, please do. But the last question I want to sneak in before we get to your outlook is institutional ownership of single family homes, because that is another thing that is new about this cycle. And I've not been shy about sort of my personal opinion on having, too much of your national residential housing stock owned by corporations. We can put that aside for a second from an ethical standpoint, but just from an economic standpoint, obviously that was helping push prices higher, right? As you had these deep-pocketed purchasers who could actually borrow at lower rates than the average person out there and, snapping up a lot of inventory with all cash offers. But there's also the risk too that if they ever get in trouble, these companies own lots of properties, oftentimes lots of properties in the same geography. And let's say you just have a hedge fund that gets in real trouble and they've got to dump their portfolio and they can't easily find another buyer who's going to pick it all up. There's, in theory at least, the risk that they could dump a lot of inventory in a market all at once and really surprise people and depress prices. Anyways, what are your thoughts about the institutional ownership?
Yeah, so I left Fortune, where I'd been the the real estate editor for a few years, and really covered a lot of housing, to build ResiClub. And my coverage really falls into four buckets. One, I really want to cover regional housing market analytics, get a lot of this regional housing market data out there. The other one is home builders, and then prop techs and real estate startups. And then fourth, and this is the one actually I've been covering the most of, especially relative to the builders and the real estate startups, is these institutional home buyers. Because I want to have a really good, I think if people want to find a lot of great information on real estate on the institutional side, especially what they're doing in single family, you can't. There's not like a great media publication that's covering it very closely until now. So ResiClub, we've really dived in, and we're not just tracking, one or two institutional buyers. We're tracking the biggest, most of them, most of the ones that have at least 1,000 homes. We're tracking closely, not just to see what they're buying, but also what they're selling, where they're buying. And what we've seen is that on the institutional side, there was a very big uptick in institutional home buying levels. These big SFR operators that own at least 1,000 homes in Q2 2022, at the height, they were buying 2.2% of all the they were 2.2% of all the transactions that quarter. Now, as this perfect storm of low rates, easy access to capital, soaring rents, soaring home prices, as that pulled back and rates moved up, we saw a pullback in the institutional home buying levels. And so in this latest quarter, according to John Burns Real Estate and Consulting, institutional SFR operators were only 0.4% of transactions. So the overall pie of U.S. housing transactions went down. And then within that pie, the institutional side has become even a smaller share right now. And when you break out the numbers, some of them are still kind of out there dabbling and buying a little bit. And then you have some that, while there's not a big sell-off occurring, you're seeing some sell-off. And one of those is Vinebrook, which has like 500 homes for sale now. And when you look very closely at where they're selling, there's some pockets and some zip codes where they're over 20% of listings on the market, and prices in those zip codes are falling. And I think that's pretty interesting that they're having markdowns of like 15, 20% in some of those zip codes, including a pretty big sell-off in the Jackson, Mississippi market, which has been one of the markets that's correcting right now, that doesn't get a lot of doesn't get talked about as much as like a place like Austin.
Okay, so it sounds like there's a risk factor here. We're seeing it in certain markets like you're talking about, but maybe not a huge one, especially because, as it sounds like you said, they're kind of taking themselves out of the game a fair amount as the economics have gotten less favorable.
I think the institutional side is just like the short-term rental side, where they're not a huge amount of the housing market, but at the margin, they can have an impact.
Yeah.
And if that market happens to be a place where they just ban short-term rentals, well, that can have a more acute impact on the market short term. If it's a market where a big SFR operator that owns a lot of homes in that particular zip code, because when they buy in a market, they tend to concentrate within a market into a subsection of the
Yep.
market. If that operator decides to pull back from that market and suddenly, those listings have to go up for sale, that can have more of an acute impact on that market. Now, when you aggregate it all up and how that impacts the national housing market, that's when the discussion becomes a bit different. But on a regional market and on a sub-market level, they can have an impact.
It's material. Okay. Well, look, Lance, I really enjoyed this conversation, and door is open for you to come back on the program again in the future anytime you want. I would actually love, given the fact that you've really been digging into the institutional buyer side, next time we talk, I'd love to dedicate more time to really dig into that, not just in terms of the hows and the whys, but also kind of that bigger question I raised of like, is it something that we want ideally? And we talked earlier about, is this a healthy housing market or not? If you have a substantial part of the transactions being driven by these deep-pocketed buyers that can, kind of push regular people, out of the market, is that a healthy housing market? I know it's probably a very nuanced answer, but I'm curious if I can unfairly just ask you right before we move on to your general housing outlook. On a net basis, do you think it's a good or a bad thing?
I really want to stay away from having too big of an opinion on some of these different areas of housing, especially when I'm saying with the institutional side, hey guys, I'm going to be the person who comes in here and covers it, really turns over the rocks and really figures out what's going on. And I think if I'm going to be the person who does that, I got to be careful to not
You're going to
say,
be as agnostic as possible.
yeah.
Totally
So
get it.
that's one of the areas of housing that I need to be. And I think because, really, I think this country does need somebody who's out there asking big questions and trying to figure out what's going on in the space and doing it through an analytical lens. And so I want to be as fair as possible on it.
Okay, and that's very, very understandable and fair. So appreciate you clarifying that.
Because
Okay,
if I don't, somebody could use that to discredit all of my work.
exactly. Or just not share information with you, which makes it harder for you to get a true, accurate sense of what's going on and then report it to the rest of us. Okay, lastly, we're here at the end of 2023. We're looking into 2024. What do you see as you look ahead for the next year for housing?
Yeah, can I share my screen again?
Absolutely.
So I'm going to shy away from making like a national prediction for prices or a national prediction for mortgage rates. But I will make a regional prediction, which is I expect a good amount of bifurcation in the market. This is inventory levels in November compared to November 2019. And the markets that are dark brown are the places where inventory is still very far below pre-pandemic levels. The green is now at pre-pandemic, and if it's dark green, actually, it's well above pre-pandemic. And what we have seen over the past year is a great deal of bifurcation in the country. And the thing that's always been the leading indicator for prices this cycle, whether it's been up or down, and this is across regions, is the active listings. And so my prediction is that a lot of pockets of Wisconsin, Illinois, Michigan, Indiana, Ohio, West Virginia, Pennsylvania, New York, Massachusetts, Vermont, New Hampshire, Maine, Connecticut are probably going to see fairly, they're going to see some appreciation this spring. Unless things shifted dramatically with mortgage rates in some crazy way up, or if unemployment really broke quickly. But if all else today, we enter the spring like this, the technicals of the market will probably push prices up from Wisconsin, Illinois to the east.
Because inventory is so tight.
Yeah, so tight. And what I also expect is parts of Texas and some parts of the Gulf and maybe even some parts of Florida will probably see some softening on the price side. And if some of those markets only go up, like let's say 1% or 1.5% in the spring, that's a good telltale sign. And that's what I told people this year. people are like, oh, Austin has bottomed. It's had some month over month increases in like March 2023 or April 2023. But I looked at the trend line relative to Austin's history, and it looked like a market that was in correction still. Actually, Austin for 2023, the spring appreciation was the exact same amount that Austin saw in 2008. And then it went into correction in the second half of the year. And it did so in 2023 to a similar amount that it saw in 2008 for Austin, which was a market that didn't get hit as hard in 2008 too, which is something important to point out. But I think the technicals will probably see softer appreciation in the spring in parts of Texas and the Gulf. And that could suggest more price correction in the second half of next year, all else
Okay.
being.
Okay. So what I take from what you're saying, Lance, is that you kind of see current trends continuing, persisting for quite a while. So if you're in a market that inventory has increased and prices have started softening, that's probably what's going to happen. If you're in some of the other markets like, Wisconsin, Illinois, New England, where things are tight, as long as they remain tight, prices is probably still going to be supported there. And of course, you're saying, look, if something material changes, like a recession or job loss or whatever, yeah, that could shift things. But right now you see sort of whichever market you're in, whatever its current trajectory is, probably going to continue for the foreseeable part of heading into
I
2024.
think that if you're in a market where inventory is very tight and it doesn't change the next several months, you're probably going to see appreciation. Yeah. But what can occur is that markets can switch categories. So we saw that last year where a lot of Southern California had given up on prices in the second half of 2022, and then a market like Phoenix as well. But they tightened up, and Las Vegas tightened up this year too, and they stabilized a lot. But then you look at a market like New Orleans, which was not in the correction pack in 2022. And then this year, inventory moved up fairly quickly. It got back to pre-pandemic levels. And then as we moved into the second half of the year, the seasonally weaker period, it saw price give up. But both ways, for both categories, still inventory was the leading factor there, which if somebody wants to see that chart, I do make that regularly for my ResiClub Pro crowd. So ResiClub, anybody can sign up, get the free daily newsletter, and then I have a deeper newsletter, ResiClub Pro, which is my premium product, which has more of the deeper analytics.
All right, well, you're taking it exactly where I was going to now landing things here because I've kept you past the hour. Thank you, by the way, Lance, for giving such a great discussion here. The question I normally ask is, where can folks who have really enjoyed this conversation go to learn more about you and your work? Seems like ResiClub is the right place for them to go.
So ResiClub Analytics is the website, and you can also find me on Twitter at News Lambert.
Okay, and just real quick, give folks a sense of if they go to ResiClub, what are they going to find there?
You're going to find stories about home builders. You're going to find stories about home prices down to a regional level. You're going to find stories about inventory and inventory to a regional level. If a Fed president comes out and says something really important, I'll do a piece on it and get the quotes and the context. And any big shifts in the housing market, it's covered there. And then I also have interviews with executives throughout the space, whether it's KB Home CEO or Amherst CEO. And then I do stories on, new companies in the space, like, Rome is a new company where you go to their website and you can find out if a home for sale today has an assumable mortgage. And so some of these homes for sale on the market have 2-3% mortgage rates, and you could assume them if they're a USDA loan, a VA loan, or an FHA loan, but you have to know if they have that loan, right? And so their website, they go out and collect a lot of proprietary data and figure out what homes for sale currently have assumable mortgages. So stuff like that, and kind of telling readers, what's going on in the market and what's available today.
All right, fantastic. Well, folks, if you've enjoyed this conversation with Lance, would like him to come back on the program in 2024, whenever he sees, something shifting in his outlook that's material for home prices, please encourage him to do so by hitting the like button, then clicking the red subscribe button below, as well as that little bell icon. And just a reminder, while this new Thoughtful Money channel is still young, the growth in our subscriber base here on YouTube actually makes a big difference in catching the attention of the YouTube algo. So if you can click subscribe, it's totally free. That really does help us out here. One last thing too, just a reminder to folks, I'm continuing my practice of writing my Adams notes, basically my cliff notes to these interviews that we do here. If you want to get them for everybody that I've interviewed on this channel so far, including for this interview with Lance, just go to my Substack. That's adamtaggart.substack.com. It's the premium members there that get those notes. There's a bunch of other information that I share if you just sign up for free. But to get the notes, subscribe. And just a reminder, the price to subscribe, it's very cheap right now, $8 a month. It's going to go up to $15 a month by the end of this month. If you sign up now before January 1st, you'll get grandfathered in at that lowest price for as long as you remain a subscriber. So if you're interested in subscribing, I'd recommend you do it soon. Lance, as we wrap up here, I've got one last question for you. It's one I've been asking to folks recently, and the audience has really appreciated it, which is, we just spent the past hour talking about housing and really things that are related to financial wealth. What's a non-financial investment that you would recommend the audience here consider adopting?
Most important is always, time with the people around you, like close family members, close friends, making sure that you treat those relationships and you invest into those relationships, because I think that has a lot of impact in the value of your life and your happiness, which of course, impacts everything. So I think investing also in relationships.
I can't agree more. Sadly, given my family's news over the weekend, losing my father, huge reminder of the importance both of relationships, but of maximizing the time you have, because you don't necessarily know how much time you've got with everybody in your life. You certainly don't want to be regretting discussions not had or time not spent once folks are out of your life like that. So I can't agree more. My wife, who's a marriage family therapist, would put your answer at the top of her list too there, Lance. So great answer. Thanks so much. Lance, really appreciate you being on here. It's been a great discussion. Thank you for coming on the channel. This was your first appearance, first time us having talked. Really look forward to having you come back on in the future when you've got an update to your outlook there. Everybody else, thanks so much for watching.